They did everything right. Paid off their debts, paid off their student loans, then paid off their home, and still ended up here every morning, bumper to bumper, 6 a.m. Same commute to the same job, debt-free but not free, until they learned another game entirely. Now, they own 5 rental properties. Tenants pay every month and they get $28,000 a year in passive income landing in their account while they sleep. So here's the question. How do you turn the equity sitting in one ordinary home into 5 more properties without winning the lottery or saving for a decade? That's what this video is about. We're going to unpack exactly how Marques and Shyra went from debt-free homeowners to a 5-door rental portfolio, the tool they used, and the moment they almost lost everything, and the discipline that separated their story from the cautionary tales of 2008. Stay with me, because at the end of this video, I want you to be able to answer one question for yourself. If your house could buy 5 more, should you let it? Let's start with a number most homeowners don't think about clearly. Equity. It's simple. Take what your property is worth, subtract what you owe. What's left is yours. So a $300,000 home and $180,000 mortgage, that's $120,000 in equity sitting inside your walls right now. And here's what's happening to that equity every single month, whether you notice it or not. Your mortgage payment chips away at the principal balance. Prices in most markets trend upward over time. Your equity grows from both directions simultaneously, quietly, without you doing anything. Most people treat that equity like a trophy. You look at it, feel proud of it, and leave it completely alone. And after 2008, that instinct makes total sense. HELOC volume has fallen by roughly half from its peak. Only a small slice of households keep open home equity lines today, because an entire generation watched friends and family borrow against their homes, see those homes lose value, and end up owing more than the properties were worth. The hangover from that crash is still running, but if you keep treating that equity like a trophy, you'll never win in this game. Let me tell you about the 2 types of players. On one side, you have the security mindset, pay off the home and never borrow against it again. You can sleep well knowing you own it outright. On the other side, you have the investor mindset where you let the equity work instead of sit. Both mindsets are rational and both have real consequences. The question this video is trying to answer is not which mindset is right. It's whether there's a precise, disciplined path between reckless borrowing and idle equity that actually builds long-term wealth. There is, but it requires precision and a clear memory of how people got burned last time. Marques and Shyra didn't start with advantages. They had regular jobs and regular income. Basically, there was nothing extraordinary about their financial starting point except one thing: discipline. They paid off $33,000 in credit card and student loan debt. Then they turned that same intensity onto their mortgage and paid off their primary home. The day they made the final payment should have felt like the finish line. It didn't. They were still in traffic the next morning, still trading 8 hours a day for a paycheck, and still completely dependent on their jobs for everything. Debt-free is not the same as financially free. And that realization hit hard. So they started researching. Rental properties kept coming up, passive income, assets that pay you while you work, sleep, and live. But the math problem was immediate. Saving a full down payment for each new rental at their income level would take years per property. Meanwhile, home prices were climbing. Every year they waited, entry points moved further away. That's when they looked at what they actually had. Their Sacramento condo had built substantial equity over several years of appreciation and mortgage paydown. They sat down with a lender and discovered something that changed the direction of their lives. They could open a HELOC against that equity, a home equity line of credit, essentially unlocking 6 figures of borrowing power tied to the home they already owned. The excitement was immediate. So was the dread. Their home had been the finish line. Now, someone was suggesting they use it as a starting line, and if they got it wrong, they wouldn't just lose an investment property. They'd lose the roof over their heads. Here's how a HELOC actually works. It's a revolving line of credit secured by your home with a variable interest rate. You draw from it and repay it like a credit card, except the collateral isn't your credit score. It's your house. Marques and Shyra opened a HELOC of around $120,000 at roughly 5.5% interest. And then they did something most buyers can't do. They made a cash offer on a rental property. Not because they had that cash sitting in a bank account, but because the HELOC gave them immediate access to it. Here's why that mattered. Cash offers win, especially on distressed properties, problem estates, and sellers who need certainty over price. They spotted an underpriced property in a solid neighborhood. A dump, honestly, but a dump in a good location with good bones. They beat out other buyers, not with a higher offer, but with a cleaner one. Then the inspection came back with more issues than expected. Most buyers would have panicked or walked away. They used it as leverage instead and negotiated the price down further. But let's be completely clear about what they had just done. Their primary residence now had a HELOC lien of $120,000 attached to it. Their home, the one they'd paid off, was now collateral for a beat-up rental that hadn't been repaired yet. If the rental failed, or the numbers were wrong, or the market turned, the bank could foreclose on both. One partner was nervous sitting at the kitchen table signing those documents. The other was convinced. That tension is important, because it's the right tension to have. The first thing they did with that rental was exactly what separates disciplined investors from speculators. They ran the numbers before the renovation, not after. Modest, targeted improvements. Kitchen, flooring, core systems, nothing cosmetic for vanity. Everything was chosen to force higher rent and higher appraised value. Then they stress-tested the math. Rent minus HELOC interest payments, property taxes, insurance, maintenance reserves, and a vacancy buffer. Every number had to work before they considered it a success, and it worked. Then they discovered the BRRRR method, which is really just a formalized name for what they were already doing. Buy, rehab, rent, refinance, repeat. Here's the key move inside that loop. Once the rental was renovated and occupied, they went back to a lender for a cash-out refinance. The lender appraised the property at its new, higher value and issued a conventional mortgage at 70 to 75% of that value. And the proceeds from that new mortgage went directly to pay down the HELOC, which meant the HELOC was open again, ready for the next property. Property 2 followed the same pattern. All-cash purchase using the HELOC, rehab, rent, refinance to long-term fixed-rate mortgage, HELOC repaid and reset. Property 3, same sequence. Faster this time because they knew the process. By properties 4 and 5, something had shifted. Their track record meant lenders were more willing to work with them. Cash flow from earlier rentals was helping cover costs during rehabs and vacancies on newer acquisitions. They also did small cash-out refinances on their earlier properties as those values grew, using that equity to supplement the HELOC on later deals. But 1 month stands out in their story. 2 vacancies at the same time. 2 units were sitting empty. That means 2 mortgages still due. They made it through because of their reserves. Not because the strategy was perfect, but because they'd been conservative enough to build a cushion. That month is a reminder that the playbook only works with the discipline rules intact. Never pull out more equity than still allows each property to cash flow after all expenses. Buy under market value without exception. Renovations are to force appreciation, not satisfy personal taste. And maintain enough reserves to survive rate increases, vacancies, and unexpected repairs simultaneously. Let's step back from Marques and Shyra for a moment, because this story has a darker version, and it played out at scale not long ago. Between 2003 and 2006, HELOC balances roughly doubled across the country. Homeowners borrowed aggressively against rising values. Banks wrote loans with loose underwriting and dangerously high combined loan-to-value ratios. That means equity buffers were thin or non-existent. The assumption put into almost every one of those decisions was the same. Prices will keep rising, but they didn't. By late 2009, roughly 23 to 24% of all mortgaged homes in the United States were underwater. In Nevada, Arizona, Florida, and California, the numbers were far worse. Homeowners owed more than their properties were worth. Foreclosures spiked, and those with multiple leverage properties lost everything simultaneously because every property fell in value at once. And here's the detail about HELOCs that most people don't know until it's too late. They're adjustable, and they're callable. When markets turn, banks can freeze HELOC credit lines, cut limits without warning, or in extreme cases demand full repayment. Borrowers who were counting on that credit for rehab costs or carrying expenses suddenly had no access to capital and no backup plan. That's why Bankrate and Experian both explicitly caution against using home equity for speculative investing. Not because equity leverage is always wrong, but because tying volatile investments to your primary residence adds a dimension of risk that a margin account or business loan simply doesn't carry. With a margin account, you can walk away. With your home as collateral, you cannot. The difference between Marques and Shyra's story and the 2008 cautionary tale is not the tool. It's the discipline. Property 5 closed on a Tuesday. That's 5 rentals, all with tenants and all generating income. Combined projected passive income after all expenses, $28,000 a year. That number means something specific to them. It means one of them could realistically reduce their work hours. The psychological shift they describe is from seeing their home as a finish line to seeing it as a starting line, a productive asset that launched something larger than itself. But here's what their story isn't. It's not a clean triumph. Their leverage is higher than it's ever been. They carry more mortgages than most people are comfortable with. They manage 5 properties with real tenants who have real problems. Repairs happen, regulations change, so the headaches are permanent. The week they closed on Property 5, Property 3 had a plumbing emergency that cost $4,000 and required 2 contractor visits. Let's break this down into a framework you can apply to your own situation. Step 1. Build meaningful equity in your first property through paydown, appreciation, or both. You need a real buffer above whatever you borrow, not a thin margin that disappears with a 5% price drop. Step 2. Access a portion of that equity through a HELOC or cash-out refinance. Conservative loan-to-value. Enough equity remaining that a market correction doesn't put you underwater. Step 3. Use those funds only for under-market acquisitions that cash flow at current rents and current rates without assuming future appreciation. If the numbers only work in a best-case scenario, walk away. Step 4. Stabilize each asset through rehab and tenanting. Then refinance to long-term fixed debt. Recycle the capital. Rebuild reserves. Repeat only when the foundation is stable. This approach makes sense if you have strong and stable income, meaningful equity already built, solid credit, and the temperament to run a small property business without losing sleep over every vacancy. It makes less sense if your cash reserves are thin, your income is inconsistent, or the properties you're targeting only pencil out at perfect occupancy and optimistic rent growth. And here's the honest line that mainstream financial guidance draws. If it feels like gambling, it probably is. The difference between leverage and speculation is whether your numbers survive a bad scenario, not just a good one. One final and important note. Nothing in this video is personalized financial advice. Before you open a HELOC or make an acquisition decision, sit down with a qualified lender and advisor who can stress test your specific numbers, income, and risk tolerance. Here's the question I want you to sit with after this video. Is your home just the place you live? Or is it also the engine that could fund the life you want? That answer looks different for everyone. What matters is that you answer it deliberately, with real numbers in front of you, not out of fear and not out of excitement, but with both eyes open. Because the families who lost everything in 2008 and the families who built portfolios through the same era were often using the same tool. The difference was never the equity, it was always the plan. In the next video, we're going to take this exact playbook and stress test it in a worst-case scenario. Rate spikes, back-to-back vacancies, and a market correction hitting all 5 properties at once to see exactly who survives and who loses everything. See you there.